Vienna University of Economics and Business.
Excuse me, sir, where's the second mic?
The second microphone.
We have only one mic.
Oh. To the other team. Just a second. Okay.
Ladies and gentlemen,
I apologize. There you go. Okay.
ladies and gentlemen, we are proud to present our final results of our Don't Co analysis. My name is Max, and these are my teammates, Selina Chang, Fabian Stiebel, Dennis Keiler, and Maximilian Strickner. Don't Co is a full-service provider with tailor-made solutions in the catering entertainment, and the management having a proven track record of shaping shareholder value. We believe that Don't Co's strong financials, its innovative power, and its unique market position will lead to ongoing sustainable growth and a target price of 117 euros, which comprises an upside potential of 11%. The company is composed of 3 fast-growing segments, all of which are supplied by shared gourmet kitchens. Its airline catering division acts as a full-service provider for more than 60 airlines worldwide. Premium quality and locally prepared food sets it apart from its peer group. The main value driver in this division is the joint venture with Turkish Airlines, which provides its airline catering in its international event catering. Don't Co has built an international customer portfolio. It is one of only few global players providing comprehensive catering infrastructure. Its restaurant, hotel, and lounge division is the creative core of the group. It represents Don't Co's marketing tool. Don't Co operates 29 kitchens in 10 countries on 3 continents and employs roughly 10,000 people. Don't Co builds and maintains a premium brand portfolio, while its strategy is focused on sharing assets among its segments to unlock value through synergies. That enables competitive growth along multiple dimensions.
Don't Co is pushing innovation in strong growing industries, which is also reflected in its market performance, outperforming its peer indices in the recent years. The company established itself a strong position in an oligopolistic market for international event catering. Top-line growth contribution can be expected due to the servicing of growing high-profile sports events such as the Formula 1 and the UEFA Euro 2016. However, other parts of this market are showing clear signs of saturation. The travel and leisure industry is being shaped by the shift of consumer demands towards experience-driven purchases. Low entry barriers in combination with the potential for high-scale growth open the market for fierce competition, which in turn puts pressure on operating metrics of the industry. Don't Co's main value driver, the airline catering segment, is being driven by the outsourcing trend of large airlines who seek unique selling propositions in their own fierce competitive environment, which puts a great opportunity for small caterers such as Don't Co. The airline industry experiences strong tailwinds due to growing revenue passenger numbers, which have been above GDP growth rates for all regions. This growth is being captured by low-cost carriers on the one hand and geographical connectors such as Emirates and Qatar on the other hand. Don't Co's main customer, Turkish Airlines, has been growing its revenue passenger numbers with a CAGR of 17% in the past years. We expect this trend to continue due to the prospects of a new airport in Istanbul, which will have a maximum capacity in 2021 with 150 passengers, which makes it one of the largest airports in the world. This growth will predominantly take place through long-haul flights, which offer a larger share for airline catering revenues. This is complemented by the growing demand for in-flight services, which have been growing with a 7% CAGR in the past years. The airline catering competitive landscape is set up out of 3 peer groups who compete with each other with different strategies. Firstly, the small independent caterers such as Don't Co, the Western Flying Food Group, who compete through quality and branded services. Secondly, the airline-related caterers such as LSG and Dinata, who compete through their synergies with the parent airline and cost effectiveness. And thirdly, the large independent caterers such as Gate Group, who compete through economies of scale and low-cost products. We believe that Donco's business model is in a dominant position in this market environment. This is also shown in its operating metrics. While being one of the fastest growing airline caterers, it has been able to maintain an above average EBITDA margin. This can be attributed to a healthy pricing power and strong operational management.
Over the first 3 quarters of its current financial year, Do & Co has been able to pursue its growth path, increasing revenues by 18.9% to a total of 710.5 million euros, while maintaining compelling margins. This growth was mainly driven by further expansion in the airline catering and the international event catering division, whereas the restaurant, lounges and hotel business has been lagging behind expectations. Margins in this segment have suffered from restructuring costs of the luxury retail brand Hediyat and the newly established hotel venture in Istanbul. However, we expect these projects to start contributing to the company's profits within this year. We see the EBITDA margin as a key metric for Do & Co. EBITDA grew with a CAGR of 17.4% over the last 5 years, while margins remained resilient above the management's target rate of 10%. While cost structure proves to be stable, further EBITDA margin development is subject to top-line performance of Do & Co. Do & Co's operating cash flow has been growing in line with its business development, while maintaining a fairly stable capex to sales ratio, averaging at 4.7% over the last years. The acquisition of the Haas House has been a special one-time effect in capex, which has recently been revised for its sale. Do & Co has a very strong balance sheet, with a current adjusted equity ratio of 37.2%. This gives a reasonable financial leverage and risk level to the company's operations, in turn boosting the return on equity to an impressive level of 23.7%. Furthermore, Do & Co has proven to be a reliable dividend payer, and we expect the company to maintain its current distribution ratio of around 30% in the future due to its strong cash-generating abilities.
The base of our valuation is a detailed sales forecast for each of Do & Co's operational divisions. We identified the number of meals served, especially to its key customer Turkish Airlines, who accounts for roughly 55% of airline catering sales, as well as new key customer acquisitions as the main growth driver. We therefore analyzed Turkish Airlines' growth plan in light of the new Istanbul airport and assumed stable growth with new and existing customers. Revenues in its international event catering division are mainly driven by major sports events and long-term catering contracts. We forecast sales of this division to grow with a CAGR of 20% over the next 3 years. In its restaurant, lounges and hotel division, a possible turnaround of its luxury brand Hediyat, as well as new innovative business ventures, can further boost sales. The company states that this will be partly achieved through M&A activity and their unique buy and build strategy. We computed the company's cost of equity within the CAPM framework. With an adjusted company beta of 0.85 and with respect to Do & Co's regional exposure, we derive cost of equity of 8.0%. Together with post-tax cost of debt of 1.8 and a target E ratio of 38%, we derive the company's weighted average cost of capital of 6.3%. To account for Do & Co's unique growth opportunities, we applied a 3-stage DCF model. We assume that after our projection period, the free cash flow to the firm growth rate will steadily decline up until 2030, when the terminal growth rate of 2% will be reached. Furthermore, we apply a marginal tax rate of 25%, which is in line with the average we saw in recent years. These model inputs lead to our price target of €117 and our buy recommendation. To take into account possible shifts in demand and profitability, we utilize the Monte Carlo simulation. Bandwidth for the most sensitive model parameters, based on historical performance, define our bear and bull cases. These model inputs lead to our price target of €117 and a confidence level in our buy recommendation of 79%.
Do & Co exposure to the aviation industry makes it sensitive to economic development. Key risks are related to human resources development, terrorism, and geopolitical tensions. Do & Co's main value driver are its market position and pricing power. A change in the EBITDA margin could result in a significant downside risk. However, we believe in management's ability to maintain profitability in terms of high EBITDA margins. Other risks are the ongoing political tension due to Do & Co's heavy exposure in the Turkish market. We identified a number of potential catalysts which we could not fully include into our valuation model, such as the ongoing negotiation with a potential new key customer, with a contract size comparable to its Turkish airline business. Furthermore, Do & Co is currently in a joint venture with Nespresso, where they're acting as the catering partner and the where they're acting as a catering partner. A successful test phase could result in a large number of catering contracts. Do & Co's brand Henry in Austria and Hédiard in France pose a great opportunity to penetrate the retail market in a larger scale. Now to conclude, while we believe there's a downside risk in Do & Co's dependency of few key customers, as well as lower EBITDA margins in the non-airline catering segment, we believe in Do & Co's ability to expand across its division, puts it in a great position for further growth, which is supported by strong financials and large cash positions. We therefore conclude to our buy recommendation based on our 12-month target price of €117 and an upside potential of 11%. Thank you for your attention. We're now ready for your questions.